Have you ever stared at a spreadsheet full of financial data and just your eyes glaze over? Rows and rows of numbers, weird acronyms. It can be a lot. Well, today, we're going to slice right through all that noise. We're taking the data on one company, Cincinnati Financial, and we're going to run it through a really simple but incredibly powerful framework inspired by one of the greatest investors of all time. All right, let's get into it.
And this quote right here, this is everything. This is the entire philosophy that's going to guide us today. See, it's not about bargain hunting for just any cheap stock. Nope. It's about finding an amazing business first, and only then worrying about whether the price is right. This single idea is the heart of the Buffett way, and it's the lens we're using to look at our company.
So, here's the game plan. First, we'll quickly break down the framework itself. Then, we're putting Cincinnati Financial to the test, one step at a time. We'll check its financial strength, dig into its profitability, see how it treats its shareholders, and then we'll ask that final, crucial question. Is the price right? All right, quick heads up here. This is not, and I repeat, not investment advice. We're just using a simplified version of Warren Buffett's principles as a tool, kind of like an X-ray, to see what the financial data is really telling us about the bones of this business. It's all about learning how to analyze a company. These 4 questions, this is our checklist. They look really simple, right? But don't let that fool you. They get right to the core of what makes a business strong and valuable for the long haul. If a company can get a big yes for all 4 of these, well, then you might have something special. So let's get started. Test number 1 for Cincinnati Financial. First things first, how healthy is this company? One thing Buffett has always loved is a business that isn't drowning in debt. Debt can be like an anchor, especially when the economy gets rocky. So let's see how Cincinnati Financial does on this very first, very important test. Okay, just look at that number for a second, 0.05. That is incredibly low. What this means is that for every single dollar of its own money, the equity, the company only has about 5 cents of debt. That's a rock-solid foundation. It tells you this business is funding itself, not relying on bankers to stay afloat. That is a huge checkmark in the financial strength column.
But look, having low debt is only part of the equation. A strong company also needs to be really good at using its money to make more money. That brings us to a metric called return on equity, or ROE. Basically, are they efficient profit-making machines? And this chart lays it out perfectly. Cincinnati Financial's return on equity is over 15%. Now, to give you some context, your average big company in the S&P 500 is hovering around 10%. So what this shows us is that CINF is way more effective than the average company at turning shareholder money into actual profits.
So, we've established the foundation is strong. The company is efficient. But you can't just stand still, right? A great business has to be moving forward. And that leads us right into our second big test. Is it actually growing? Right, so the foundation is solid. But a business can't just be stable. It's got to have a growth engine. We need to see that it's consistently selling more stuff over time. And even more important than that, we need to see that it's generating more actual cash. That's what we call free cash flow. And it's pretty much the lifeblood of a company. And wow, the numbers here are really, really strong. Just look at these growth rates. Over the last 3 and 5 years, CINF has been putting up solid double-digit growth in both its revenue and that super important free cash flow. This isn't just some one-time lucky break. This shows a real pattern of powerful, sustained growth.
Okay, let's recap. The company is strong, it's efficient, it's growing, it's ticking all the boxes so far. But there's another really important piece of the puzzle, especially if you're thinking like an owner. Does management actually share the wealth with the people who own the company? The shareholders. This brings us to our third test, shareholder friendliness. And one of the clearest ways a company rewards its owners is by paying a dividend, and even better, by raising that dividend year after year. And in this category, Cincinnati Financial isn't just good, it's part of a super elite club they call the Dividend Kings. I want you to just let that number sink in. 65 consecutive years of giving its shareholders a raise. That is just an incredible track record. Think about it. Through recessions, market bubbles, global pandemics, through all of it, this company not only survived, it thrived enough to increase its dividend payment every single year for more than 6 decades. Wow. So the natural question is, can they keep this up? Is this dividend safe? Well, that's where the payout ratio comes in. CINF's is just over 23%. This means they're only paying out about a quarter of their profits to shareholders. The other 75%? That's getting plowed right back into the business to grow it even more. A low number like this tells you the dividend isn't just safe, it has a ton of room to keep on growing.
All right, let's be honest. Cincinnati Financial has absolutely crushed our checklist so far. It's strong, it's profitable, it's shareholder friendly. It sure looks like a wonderful company. But remember that quote from the beginning? We have one final and maybe the most important question left to answer. Is it trading at a fair price?
And here we are at the grand finale of our analysis, valuation. The big idea here is something called a margin of safety. You want to buy a business for way less than what you calculate it's actually worth. That discount is your safety net if you're wrong, and it's where your real profits come from if you're right. And this is the big reveal. According to the financial model in our source data, the market price is floating around $166 a share. But the calculated intrinsic value of the business, it's over $847. I mean, just pause and look at that. That is a massive, massive difference. It suggests there could be a huge gap between what the market thinks and what the business is actually worth. To put a number on it, this gives us a margin of safety of over 80%. Think of that as the discount you're getting compared to its calculated fair value. This is the kind of buffer value investors dream of, and in this case, the data suggests it is just enormous. So let's wrap this up. We put Cincinnati Financial through our 4-part checklist. Financial health, without low debt and high ROE, that's a pass. Profitability, strong, consistent growth, another pass. Shareholder friendly, a 65-year dividend king, that's a pass with flying colors. And finally, valuation. The data points to a huge margin of safety. That's a pass. A clean sweep, 4 for 4. And all of this leaves us with one final question to think about. It's really the classic debate in investing, isn't it? In the long run, what really matters more? The day-to-day mood swings of the stock market, which give you the current price, or the fundamental value-creating engine of the business itself? Answering that question, well, that's the very heart of the Buffett way.